Hello, hello. Hello, hello, everybody. How are we doing today? It is a great pleasure to be with you this Wednesday afternoon. It is FOMC day, the reason for the season, why we are all here. I hope you guys are having a good day today, hanging out on the sidelines, watching this price action just creep on by. But we've got lots of info coming at us here in about half an hour. We've got Jerome Powell coming up in about an hour. They're going to be releasing all of the announcement here on the hour. That's going to be in exactly 30 minutes. We're going to get the announcement on what the Fed is going to do. And it seems like the overwhelming majority seems to believe that a 25 bips rate hike is in our future here. Now, I've been trying to assimilate all of the information all day today. You know, of course, there are Twitter spaces going on. There's a lot of information happening. What's up, DU? How are you doing today, man? Hope you're doing well. It's good to see you here. What are your expectations for today? It seems like what I was going to say was the last number that I heard was nearly 92% chance of a 25 bips hike. This is up from 85% like just a day or two ago. So DU, no comment. So 75 bips. I mean, it seems like maybe the market would be happier with a bigger hike than a lesser hike. It'll be interesting to see. What's up, Jonathan Wage? How are you, man? It's good to see you. I hope you're doing well today. What are your expectations for today? I'm very curious to know. We got a bunch of people here already. What are y'all's expectations for today? It does seem like this 25 bips hike is pretty much priced in. And so the big question that I have is what comes next, right? If the 25 bips is what's expected and what everybody is kind of anticipating, we have to assume that maybe it's partially baked into the current price. It's going to be all about what Jerome says. And we are going to be tuned in to what Jerome says. I've got him hanging out just above me here. You guys can see that. I'm going to turn him on when he goes live. So we'll get to tune into his presser and get some feedback from him directly. You know, we're going to hear it from the horse's mouth, right? Dustin, you think that Jerome is going to do exactly what he says he's going to do? Yeah, I think so too. And it all boils down then to his tone and what he has to say about what's going to happen going forward. Is he going to continue with the rate increases looking out into the summertime? Is this the last one and then they're going to pause? Is this the last one and then they're going to maybe start cutting? What's up, Sonia? Good to see you. Hope you're well today. J. Powell got everyone in a headlock, and I don't think he's going to let go. It doesn't seem like it. I mean, the economy seems to be quite stronger than anybody is willing to give it. Anybody's willing to give it credit for. That's kind of seems to be the overwhelming reality. What's up, Robert? Great to see you here. Hope you're doing good today. What else? What do the rest of you guys think? Past couple of rate increases that we've seen. I've got up on the chart here. This is just a SPY chart. So these are the past 3 FOMC meetings. Back in December, we were down nearly 8%. Only took about 6 days for that move lower. Then in January, we saw a move higher for a couple of days, but then we sold off for a while. But the big move came then at the end of March there. We had a nice, another 7% move higher over the past couple of weeks. What's up, Ziv? How are you today? Hope you're well. So it's going to be really interesting to see. You think we break up before we head to new lows? You know, they had that little, you could call it like a bear trap where they took out these lows from that, you know, multi-week snooze fest consolidation period that we saw kind of all throughout of April. They took out the lows, ramped it back, and now they've come and they filled that little fair value gap there. This guy filled it really nicely yesterday and held it exactly where they should have. It's going to be really interesting to see what they end up doing here today. Are there any particular tickers that you guys are keeping an eye on for maybe like bigger, broader, what's going on out there in the world? Of course, we talk a lot here and on the spaces about XLF. And, you know, so far, obviously, the big move yesterday came off of the renewed fears with the banks. But the big boys are holding in there, right? The big boys are maintaining that 30.5 level. This is the level that a lot of folks are pointing to as the make or break it. There's a lot of folks that believe, you can't have a bull market without the financials participating. This is a big level to maintain here. Obviously, major resistance for nearly a decade. We broke out of it. We came back. We held it back in October of 2022, and we continue to hold the line here at this 30.5 spot. So the question is, are the big banks going to follow in the same track as the regionals, or are the big banks going to suck up all of the liquidity of the regionals and become even more powerful and stronger? And, I think only time will tell on that. I guess we'll have to wait and see. It is a question that I'm going to be asking. We are having a Twitter space today at 6 p.m. Eastern time, a FOMC wrap-up space with a handful of great guests. We've got Caleb Franzen. We've got Andrew O'Connell from Real Pristine Cap. We got Ripster. We got Alex King from Cestrian Cap. We got Steve Straza from All-Star Charts. These guys are going to be joining us at 6 p.m. Eastern time on Twitter to wrap up what they came to understand from this FOMC meeting today. And one question that I'm going to have for those guys is, what are their thoughts here on the big banks? Do they anticipate that the big banks are going to follow the same track as these regionals, or are they just going to suck up all the air in the room and become even bigger banks? I'm curious about that because I don't know. I know energy was another one that folks were keeping their eye on, and I'm curious about this as well. I'm curious to know how important these levels are. I don't follow energy personally all that much, but these 2016, 2018 highs obviously seem pretty important. We held them, for the most part, back in June 2022, and now we're starting to retrace back into them. So that to me seems like a pretty important area for these energy names. I don't know. What are you guys watching? We got Apple. We got Apple reporting tomorrow at a huge level. Apple at a huge level. We talked about this on Rahul, on the Rahul space on Monday. I pointed out, just a simple, if you're a trend following investor or trader, it's a very, very simple chart going on here, right? You got lower highs and you got lower lows on Apple on the big time frame. And you have to wonder, we are coming right into that last major high from back in August. So you have to wonder, what are they going to do here if they're able to make a new high and really push this thing? I think I read today, we're 6% from all-time highs on Apple? I believe is what I read. 7.5% looks like from the current price. From the high of day, you're at about 7% from all-time highs. So, can they push this thing into new all-time highs? And if they can, with the earnings tomorrow, you've got the Apple Bank essentially now with the high yield savings account. If they can push this thing into new all-time highs, what does that say for the markets? Can Apple thrive against a weak market, or is Apple going to be the thing that really kind of sets the tone? I don't know. I'm anxious to see. Naresh, what's up? How are you? Corbin, how's it going? 88, how are you? New lows. 88 says new lows. Well, relative to what, 88? And new lows on what? You saying SPY? You saying the Qs? What are you thinking? Naresh, Melly, and Etsy reporting tonight. Let's take a look. I know that we looked at Melly, or I looked at Melly. What was I looking at? Oh, this is what I was looking at on Melly. You had a double top pattern This is what I found interesting on Melly. You know, you've got the double top pattern, and then you have your support level. This is the low in between the two highs, right? And initially you rejected at that level back in March of last year. Well, we've come back and now we have gained it and we're holding it. So this is pretty darn bullish for Melly here. This is what you would want to see. It's definitely been some sideways action on this thing for quite some weeks here, for nearly, 6 weeks? So it's all about earnings today, that's for sure. I would agree. Meta had a big seller. I heard Meta had big sellers yesterday too. Corbin, this unique opportunity. Could TrendSpider make a chart where the x-axis measures units of volume instead of time? I've been drawing my charts on paper. There's nothing like it. That's interesting. How about we do this? I'm going to take your comments and I'm going to put them in the customer feedback channel right now for you, Corbin. Let me do that real quick. All right, submitted. I got you. And also, DU, if you're still tuned in there, maybe you could speak to this question from Corbin. Yeah, man, absolutely. Happy to do that for you. The Weiss wave. I've never heard of a Weiss wave before. You cracked it. Oh, DU's way ahead. Corbin, DU is the real the man you really want to be speaking to here. But DU, just so you know, not allowed to post all caps. Nightbot is a stickler for the all caps. So we got about 20 minutes here before the announcement. I'm curious to know if there are any particular tickers you guys want to keep your eyes on. I'm going to switch over to multi-symbol view probably about 5 or 10 minutes before we get this announcement. I always like to have a mix of things that everybody wants to look at, some futures, some ETFs, some crypto, you know. Y'all hit me with tickers that you think are important that we should really keep our eye on. But also keep in mind, you know, Apple, Microsoft, Tesla, you know, all of these names are going to move relatively similar. So let's come up with a good mix of sectors and ticker symbols. Apple momentum looks like it's already overbought, so I'm going with odds on the way down from here. That's from John Mervin. Let's take a look at that. I haven't really looked at momentum on it. As you can see, I tend to keep my charts relatively clean and clear here. But let's put up some RSI and some MACD. And just kind of see how things are looking. I mean, RSI don't look so bad on the weekly. You're nowhere near oversold here. Or rather overbought. And weekly MACD is looking pretty nice as well. Not suggesting any sort of turnover yet. If we go to the daily here, it's definitely cooling off and consolidating. And I do see your negative divergence here on RSI. You certainly have lower highs on RSI into these higher highs on Apple. So that could be a little bit of a sign that things are starting to turn. Let me check out volume by price and kind of see where we're at. Yeah, there is a bit of a high volume node up here at this 172 level. Quite a bit of volume has exchanged hands up here. So this is the last frontier for Apple. This thing either has to gain and make a new high, or this could be the beginning of an entire downswing. We'll have to see. AMC, interesting pick, Cheryl. Naresh's thinking all of the techs are going to bounce, so you got TQQQ calls. Uber been going ham. You're right, John. It's so crazy how two companies in the exact same space can do so differently. You look at Lyft, and my gosh, this thing has just been a serial underperformer. Absolutely awful. What's kind of interesting is actually I've in my time using shared shared taxi like this, I always use Lyft. Maybe I just like I just like the branding of the company more. I don't even know. All right, Chewy, that's an interesting one to watch. Wheat. Yeah, see, I think it's just, maybe it's just like the colors of the logo. Like there's really no difference in the experience from my experience. I'd be curious to know if there's if somebody has like some strong opinion about it. I do have both apps, and I guess really I'll go with the one that will get me the fastest for the cheapest. I'll check both. Whichever one will get me there fastest, cheapest is the one I'll go with. But I tend that's usually Lyft. Maybe fastest, cheapest is in the way. Slowest, more expensivest is better for the investors. Sean, you feel like Lyft has a better culture. Yeah, that I think that's part of it for me too. It kind of seems a little bit like nicer or something, like more friendly. And I'm a nerd that likes those sorts of things. CVX, that's a good one, Cheryl. We'll definitely put that up. We'll put up TLT for sure. Actually, let me go ahead and get to cracking on that here. I'm going to add it real quick. Make sure we got everything we want to watch up. And we're going degen, so we're going 1 minute time frame here. So I've got SPY, QQQ, IWM. Presumably they'll all respond in a very similar fashion, but I always like to have them all up. And then I've got Bitcoin, which I think most folks would want to watch. I'm kind of open to whether or not we have anything else other than Bitcoin. But let's throw up TLT. Here's your TLT chart. CVX. I had Oxy, but same idea. Do we really want to watch AMC? Oh, you nerd. I'm going to keep Apple up. Apple is going to be my little temperature gauge here for big tech outside of QQQ. I mean, Apple and QQQ is going to do probably something similar. But since Apple does have earnings tomorrow, maybe the response is a little bit more muted on Apple, at least maybe to the downside. I don't know. It's just kind of like some weird gut instinct or something that I have that might happen. Let's see, KRE, that's a good one. I'm almost more interested in XLF because KRE is just getting so rocked. Could we do XLF instead of KRE? Is that cool? Or do you want to definitely do KRE? I'm open to either. Wheat. I don't know too many people who trade wheat. Your little minute chart here looks quite nice though. XAUUSD. What is that? Is that Australian dollar? Oh, it's gold. Okay. We could do that. Usually I would just have a GLD up, but this works too. VIX. So VIX is going to be an index. I'm going to put up a VIXy chart so that we're not delayed here. This is short-term futures. Crude oil. Let's throw up crude oil futures here. What else you thinking? I got 4 more panels. Obviously, the panel behind my head is kind of useless for us, but I got 4 more panels that we can use. Let me go back up here and see what you guys are saying. Neo? That's an interesting pick. I don't necessarily mind watching Neo, although I would rather watch the China ETF. Walmart Mickey D's. I think let's go Mickey D's, because that has been an absolute monster lately. Ha ha ha! DU. Let's go to PLTR for DU. We got to give DU what he wants. Nat gas? You don't actually want to see it? DU, it's going to come around one of these days. You think so, right? Sometime between now and 30 years from now, people will finally understand what the company does and see the value in it. I mean, it kind of is a little surprising to me that it's performed so poorly. I think, you guys, instead of KRE, are we cool with changing KRE to XLF? Because we know KRE is doing terrible. XLF kind of feels like the thing we should be more so focused on. And then that would cover Schwab. EQT, I'm not sure what EQT is. Is that like Equid? What is EQT? Let me see. I don't even know. EQT Corp. What is this? I don't know this one. EcoSignal, good morning. Oh, right, EQT. We've talked about EQT before, huh? We've talked about, all right, well, then what I'm going to do, if DU doesn't care about PLTR, then I'm going to put natural gas down here so that we can keep an eye on it. It's kind of hard to see. Let me see if I can, you know what I might do? Y'all, just for the heck of it, I'm just going to remove this momentarily. Y'all don't need to know my name. You guys know my name for the most part. That way we can now see everything. Yeah, sure, right. This is why the ETFs, I think, are the way to go. That way we can just really cover everything more easily. Individual names are going to do what they're going to do, but they're going to go in the direction of the major ETF for the most part. So let's talk about expectations here. We've got 8 minutes until the announcement. Everyone is expecting the same thing, right? And Powell hasn't spoken yet, so Powell can't come in there and throw a bomb. So since we all kind of assume 25 bips, the market's totally anticipating it. Are we going to get some sort of big reaction at all? Or is the real reaction going to come once Powell starts speaking? Now, of course, there is always the fade the first move idea. There's the reaction to the announcement, and then there's the counter reaction to Powell. And we do see it pretty often. Not necessarily always that you should be fading that first move, but oftentimes you do get a big move, and then Powell comes in, starts talking, and then the move reverses. And then he gets done talking, and then the move sometimes reverses again. Is y'all's expectation something similar here today? I mean, there seem to be no doubts about what's going to happen today. It's all about what Powell's going to say. So then if there's no doubts about what's going to happen today, do the markets really react that strongly? I don't know. Makes me wonder. Cheryl, nobody is saying 50 bips though. That would be like total out of nowhere. 92% chance of a 25 bips hike. Yeah, DU, you say a run, we've just been running up into this and it's going lower. If that's the case though, then does it initially go higher? And then once Powell starts talking, then they sell. Why is IWM running? I don't know. I think probably because it's in a worse place. It's coming off of levels that are quite lower than the other major indices, than SPY and the Qs. I mean, it's still in pretty terrible shape. Trading below the anchored VWAP from the October lows, which seems like a pretty key spot for it. Let me go to a weekly here. I mean, IWM looks a heck of a lot like XLF, right? Those 2018 highs, 2020 highs before the COVID crash. I mean, this is your line in the sand. But being stuck below the VWAP like this is no bueno. But it's also holding lows. Looks like they did. I guess they did technically, back in March. They did scoop your December lows, but they held the October ones. Will Yellen be talking today? You know, I'm curious to know if any of the folks in the audience for the presser ask him about the debt ceiling and what his thoughts are on that. He'll probably say we have nothing to do with that, so why are you asking me about it? He has a tendency to shut questions like those down. I'm going to go back to multi-symbol view here because we are getting close to time. Chris says third move is usually the real move. So that's the one we're looking for. John says smart money made their moves yesterday. It's very possible that they did. Bradley, I will not be trading live. No, trying to manage a live stream and trading is, I've found that to be a very difficult task. Sonia, you really think that they pause here? You think that that's a thing they're going to do? Vibhu says it doesn't matter. And that's right. No one knows what's going to happen. You're right. I think Vibhu, with the comment of the afternoon so far, trying to make a prediction is a fool's errand. Because you're right. We have no idea how the market's going to react. Only 1 week, EcoSignal, only 1 week ago, Fed Watch Tool had July Fed funds up to 3 raises, 75 bips probability of 24%. Today it's 0. Isn't that crazy? All right, DU. Well, it's a pleasure. It was a pleasure to have you on, as always. I hope you have a great rest of your day. If you can tune in for the space at 6, should be cool. Join us. 88's doing it. 88, you're playing this, huh? 170 puts expire today. 5 cents. I want to give a big thank you to everybody who is here right now. If you are enjoying this live stream, we try to do these anytime there's a big data event. Please give us a like and a subscribe. Specifically, subscribe to the channel. This will allow you to be notified anytime we go live. We love doing these things. So do help me out with that. I would be very appreciative. We are about to ramp up our YouTube channel activity. So if you want to be keen on all of the things that we're putting out here on YouTube, this is your chance to be reminded to subscribe. Also, while I got you guys here, if anybody's not yet a TrendSpider user and you're interested in becoming one, let me hook you up with a discount coupon. With these announcement days, we always like to bring something special to them. And today's no different. Oh, the market's moving. Here we go. And the first direction has been chosen, it would appear. Crypto chilling. Like I was saying, well, hold on. Let's talk real quick. Let's talk about the news here. A nice 25 bips hike. Fed raises benchmark rate 25 bips to 5%, between 5 and 5.2%, 5.25% target range. Fed omits prior language that signaled more hikes ahead. Fed extent to which more firming needed hinges on economy. So what I was going to tell you guys is with these big data announcements, we always like to bring something special to the show. Today is no different. Today we are bringing on our head developer. He is a big brain behind a lot of the awesome tools that you guys can find on the TrendSpider platform. So he's going to be coming on to join us to talk through one very specific tool called the Price Behavior Explorer. This is a tool that's found in your strategy tester for anybody who is utilizing the strategy tester to either just test their strategies or take it a step farther and turn those strategies into live trading bots. He's going to be coming on after the Jerome Powell presser. And he's going to be talking us through some of the peripheral data that you can read in the Price Behavior Explorer, be breaking down how to utilize it. I'm really excited to have him on. He's like I said, he's a big brain fellow, and he's going to be answering questions. If you guys have any questions for him, he'll be happy to answer those questions for you. But he's got like a 15-20 minute presentation prepared for you guys. So after the Jerome Powell presser, if you're interested in learning more about the strategy tester and specifically the Price Behavior Explorer within the strategy tester, stick around. We've got Ruslan on at the end of the presser. So I want to let you guys know about that. Sonia, she's got some targets for us. So initial move higher, and now we're selling off a little bit. Trapping some buyers on the top side. I'm just going to pop in really quickly to the SPY chart. Zoom out just a smidge. See if they did anything interesting. As far as previous price action is concerned, not really anything interesting there. me go back into multi-symbol view. Natural gas, unfazed. NEO, unfazed. Gold versus the US dollar, phased. Or I guess maybe unfazed. It's gaining. McDonald's unfazed. Crude, relatively unfazed. So we got our little range, at least on SPY and the Qs. They just made a new high a day. They just took out some lows. And my guess is now we chill and wait for the big man to come and speak to us. Now, one thing that I will say here, if anybody's watching from anywhere else, oftentimes our friend Jay Powell is, or the website that streams our friend Jay Powell doesn't always want to work properly for us. So if for some reason there's a smidge of a lag when he comes on, just be patient. We always get it up and running. The presser is the main event, Chris. You said it. The presser is absolutely the main event. That is the big key here. Just check on something real quick. So we got our 25 bips hike. Omitting prior language that signaled more hikes ahead is interesting. Deletes reference, I'm just reading this on Twitter, deletes reference to some additional policy firming. Some additional policy firming may be appropriate. They deleted a reference that said some additional policy firming may be appropriate. And this was a unanimous decision. Interesting. I'm going to read a little thing here from the statement. Recent indicators point to modest growth in spending and production. Job gains have picked up in recent months and are running at a robust pace. The unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. This is coming from the statement, from the FOMC statement. The committee seeks to achieve maximum employment and inflation rate at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 4 3/4 to 5, from 4 3/4 to 5%. The committee will closely monitor incoming information and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the extent of future increases in the target rate, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in its previously announced plans. The committee is strongly committed to returning inflation to its 2% objective. So, same thing we've been hearing, right? Tabrez, what's up, Tabrez? We do not offer Indian exchanges at this time, but hopefully other countries' exchanges will be coming in the future. I cannot speak to when that might happen, unfortunately. But I would imagine that we intend to add them eventually. Robert, I think the trick with that is don't utilize your money when he's talking. But I think you're right. I think most of us would, right? Eco, that's kind of interesting. Just heard that Australia had to unpause, started raising again. Yeah, that seems not only counterintuitive, but that seems detrimental to the overall good standing of the Fed. No? To undermine themselves in that way seems like, well, how can we trust them going forward? If they say they're going to pause now and then they just end up raising later. I wonder how much time, do you know, Eco, how much time went between when they paused and then had to re-raise again? And when they paused, did they happen to say we might have to raise again, but for now we're pausing? Or were they like, hard line, we're pausing, we're done? Because then that's a whole other conversation, right? We got 20 minutes until Jerome Powell comes up and graces us with his presence. Is there anything that you guys are watching on your end that is moving in an interesting way? I mean, I could do a little bit of scanning. I kind of don't want to take my eyes off of the big chart here. Interesting, Eco. We'll have to look into that. Yeah, you know, the sentiment that I'm reading, Corbin, is that they're looking at lagging indicators. There are quite a number of voices out there saying that the Fed is over tightening because they're looking at lagging indicators. I am in no way, shape, or form any sort of expert on these sorts of things. I rely on smart people to tell me what's going on in that regard. But depending on the lag of the indicators that they're watching, you would assume then that's how we'll know how obvious it'll be by the next meeting. I mean, all in all, market's holding in pretty well and loosely kind of what we talked about just before the announcement, right? Like everybody knows 25 bips is coming. How can the markets have a big move if everybody knows it's going to happen? Yeah, John, I mean, the thing about that, though, there are actually some like serious experts on Twitter, and then it's just about filtering the noise. I almost had us tuned into the conversation that's happening right now on Mario's page. Obviously, if you're on Twitter, you know Mario. This dude hosts the biggest spaces pretty much in the world, and he's got a live FOMC reaction going on right now that I kind of wanted to tune into. And I still could, if you guys want, I could tune into it and we could just listen to that for a little bit. There's smarter people talking about this on there than I am, that's for sure. Yeah, you guys want me to do that? I'll do that. Let me
trying to determine is the Fed
Can you guys hear this okay?
Lower, I'm trying to look and say, where can I make money, as a
Peter
trader? And
Brandt talking
so,
right now. Interesting.
I'm looking at long 2 year, short 30 year on the futures. I'm looking at uh, being short, let's say the June 24s
Turn
on
it
the
up.
SOFR.
Still too quiet.
I'm looking at, short the dollar.
How's this?
Dollar, yeah, the dollar's rallied off the daily lows. But if you take a look at where the dollar is, British pound is close to making a significant new high against the dollar. Swiss franc is within an eyelash of being at an all-time high against the dollar. And so,
It's a
that's
good
where I
thought.
just
Throwing
see
up the
the
dollar.
opportunities are in being not necessarily short the
Touch more.
dollar index, but long the Swiss against the dollar, long the 2 year, short the 30 year on the futures side, and taking a look at what point do we say, my goodness, not only is the Fed not going to raise more, but the SOFR market's got 725
We good?
basis point cuts built into the SOFR into June 24. So I just see those as really interesting trading opportunities, Mario.
So Peter, let
Awesome.
me just tell you what the AP and Wall Street Journals, how they're interpreting this. So the AP says the Fed signaled that it may now pause the streak of 10 rate hikes that have made borrowing for consumers and businesses steadily more expensive. Wall Street Journal's Timirayo said the FOMC statement. Hold on, so I've just muted you, Peter. So before you speak, you just got to unmute in the bottom left corner because there was a lot of feedback. Timirayo says the following: the FOMC statement used language broadly similar to how officials concluded their interest rate increases in 2006, with no explicit promise of a pause, by retaining a bias to tighten. They're comparing this to 2006. I wasn't following the markets back then. So how would you interpret that comparison, Peter? So you just got to unmute your mic in the bottom left corner. You'll see that mic icon. There you go.
Yeah. I've got it. I think, I don't have a response to that right now, Mario. I'd have to really take a look and see what kind of price action we had, in the yield curve and in the individual points in the yield curve back in 2006. So I'm not prepared to even respond to that. Perhaps somebody else here on the line might be able to respond to that.
Sure. So I see Eugene jumping
Peter,
in,
actually,
and Robert Wolf says
yeah.
So he's seems pretty happy with the language so far. He's going to be joining us shortly. He just tweeted about it. But Eugene, go ahead.
Yeah, actually, a question for you, Peter, and I appreciate you commenting on the yield curve and doing Treasury futures. What's really interesting is those are highly leveraged trades, right? So probably a lot of the audience, who doesn't have an ISDA or 1.5 billion under management can't play that. But we got this great audience. Would love your thoughts on how to play the yield curve for the vast majority of the folks. But also a question on trading FX. You mentioned a lot about the Swiss franc, and actually have a lot of questions on the Swiss franc. It'd be great to get Robert's thoughts
selling
because
off quite a bit, huh?
he helmed UBS during the financial crisis. But why Swiss franc over Japanese yen? Do you mind outlining those things? Because a lot of currency traders do a lot of their reflections on the dollar on things like JPY, just because of some of the predictability around interest rate policy from the Bank of Japan versus other central banks.
Well, for me, the Swiss is, that's the gold. That's the gold unit. That's the Bitcoin standard. If we're taking a look at the reason for the U.S. dollar, and again, getting in global macro stuff, which I pay attention to, but yet price action is king. But if we take a look at the Fed continuing to have the debt problem that we have right now, the question is, for me, really, we're to the point where it's not so much, as an investor, yeah, I want to make money, but
10-minute warning
really,
here on Jerome Powell live presser.
Wealth. And, to protect wealth, I'm really interested in not having dollar exposure. I don't want U.S. dollar exposure. I don't want to have a lot of money sitting in dollar denominated assets. And so, for me, that's just like, it's an insurance policy. Long Bitcoin, long the Swiss against the US dollar, with really no interest in playing the yen one way or the other.
Mr. Wolf, good to have you as well.
Thank you. Sorry I missed the last few hours.
All good, all good. We've got the decision now, Robert. Initial thoughts?
Not surprised. I thought they had to get Fed funds to north of 5%. And I think I've said, for the last couple months, I think we would continue rate hikes. I didn't
This
hear
is
the
Michael
prior
Green
speaker, so I apologize
at
if I'm
Prof Plum
repeating a bit.
99, chief strategist.
I
Simply
thought
Asset
they
Management.
left the door open for more firming. I know the market's telling you it looks like we'll have rate cuts, into the fourth quarter. I'm not so sure. I think that when the Fed talks, you listen. They were very clear. They think the banks are strong and resilient. So check financial stability. I'm not saying I agree, but let's check that. They said that the jobs market and labor market is strong and resilient. Check that. They said inflation's still elevated. Check that. So inflation's still elevated is still, of their three main concerns, the biggest concern. So I think that the market's misreading a bit. I think they'll pause, but I think they left the door open to more firming if inflation, continues to stay, north of 4.5%.
So if we,
but
go ahead.
Gas starting us off a little.
Perugia.
But
how long can they do that? There's $2 trillion of unrealized losses across the banking sector, and there's a recent paper put out by a group of finance professors from Stanford and the State University of New York that pointed out, and I'm reading from it here, a case study of the recent Silicon Valley bank failures illustrative. 10% of banks have larger unrecognized losses than those at SVB, nor was SVB the worst capitalized banks, with 10% of banks having lower capitalization ratios than SVB. Like speeding through, there's 190 banks at potential risk of impairment to insured depositors, with potentially $300 billion of insured deposits at risk. And all these banks have, we discussed this earlier in the panel, but all these banks bought in to bonds at historically high par prices and low rates, right? So they jumped in at the worst possible time, right as the Fed had created a massive liquidity wave through their QE program in 2021. And so they had jumped in, with both feet, obviously. And I mean, of course, they're constrained by capital constraints and by Basel III regulations to do this. But they have these massive losses that are standing unrealized on their balance sheets. And there's all these banks that are at risk of severe deposit flight. And not even to mention, the bigger issue here, the elephant in the room, which I've kept bringing up, is the Treasury.
8 minutes till Powell live.
And the Treasury is going to have to make a decision of what they're going to do if they have to avoid default and what kind of austerity measures they have to pull. And so rates higher for longer is just not sustainable. The math doesn't add up. True interest expense is already 111% of tax receipts in 2021. And so if rates stay higher and even if the Fed wants to fight inflation, right? The more they push the rates higher, the more they create a paradox where the most indebted entity in the system is the Treasury itself. And so the higher they raise rates, the more the Treasury will have to borrow in the future just to pay interest down on its own debt. And so they're entering a feedback loop, which is extremely dangerous. And so they need to
and
cut.
Robert, just before you respond, in 8 minutes the conference will start, and name redacted will be streaming that for us. Robert, mic is yours.
So I don't know if there was a question there, but
it's popcorn time.
I've got a question, Robert. I've got a question. So we saw Wall Street Journal. Go ahead.
Time out. Let me respond just on the financial stability, the deposits part. I mean, a few things I will say. One, inflation impacts 350 million people. So that's one. These three failed banks, all the depositors got their money. The impact on every hardworking American was
new high of day.
So those are the
for
two
the Qs
bookends.
and IWM.
With respect to making sure that deposits are secure, they have a lot of tools.
Only the SPY is lagging here.
Okay, just to be clear, there's not going to be an issue with deposits. And by the way, 99% of deposits are under 250,000 to begin with. So we should just be clear on that. Secondly, during the Lehman crisis, they started doing they put in a tool of an extension of deposits for working capital uses for payroll and other things, and it was deemed that the FDIC didn't really have that ability, but Congress passed it quickly. So one, there's other tools. As far as impairment, everyone knows with banks you have the ability to
What's up, SDW? Good to see you, brother.
To hold.
Hope you're well.
And so yes, there's inherent losses.
Did you bring enough popcorn to share
on deposits,
with everybody?
But the banking system is pretty damn resilient. Yes, there's going to be some more failures and regional bank failures, and there'll be some issues with real estate. But I don't think that is the Fed decision right now,
6
where
minutes.
they see the next 3 to 6 months. You're talking, I think, a longer term, whether the rates are 5.25 or 5.5 for the next 3 to 6 months is not going to cause the contagion you have.
Very nice.
We will see lower rates in 24. My gut tells me that they will get off their 2.5 inflation target at some point and get more realistic. But I think we're seeing, in my opinion, that the Fed tools are working somewhat. I mean, we can debate that, but the Fed tools have been working.
I mean, the tools that they have to save the banks, though, they make this problem worse, right? The FDIC only has assets to back 1.46% of the $19 trillion of deposits. And so if the FDIC starts to run out of money and has to actually outlay funds to back deposits, they're going to either have to raise their deposit requirements and the charges they make on banks, or they're going to have to ask the Fed for help. And neither of those are good. Yeah, and then the other thing is that if these larger banks swallow up the commercial banks, that's just more centralization in the long term. I mean, JP Morgan just got $100 billion of deposits at 20% of book value with FRC.
Okay.
So it's not good long term.
I don't know if you're tutoring or if there's a question there.
Oh, burn.
I'm just pushing back on the point you made.
Which point? Which was inaccurate? Because let's be honest, around the globe, there aren't regional banks that really exist. If you look in the UK, there's 3 banks.
So real quickly, just a reminder to anybody who's tuned in or who just recently tuned in, we're going to be watching Jerome Powell live. He's coming on in about 5 minutes. And then immediately after Jerome Powell gets done, we are going to be doing a little deep dive into one of the most... it's like my favorite tool on the strategy tester, the Price Behavior Explorer. And we're going to be hanging out with the head developer here at TrendSpider, fella by the name of Ruslan. He's going to be walking us through how to use the tool, how to use some of the periphery data points that you can find in the tools. So if you are interested in learning more about the strategy tester on TrendSpider, do stick around for past Jerome Powell's talk. We're going to have Russ on immediately following that. Just wanted to remind everybody.
I think we've had incredible private lenders in the U.S. Come on. This transition over the last 10 years with the shadow banking system is monstrous. We know that. Come on.
So, Robert,
where do you think when these big banks were levered at 35 times a decade ago, and now they're levered at 12 times? Didn't all go to regional banks, guys.
So, Robert, I have one question before the press conference starts in 2.5 minutes. You said you don't expect rate cuts, even though the market's pricing those in. I agree with you to some extent that I think the Fed only capitulates and fully pivots to rate cuts.
Now I owe you a call.
In the case of an actual
Here's my call.
And we haven't seen that. We've had a couple.
The market is not done with volatility for today.
Well, clearly it wasn't enough to move the needle to a full pivot. So I would agree that they will hold rates.
And they use the word firming, right?
How's that for a call?
Certain words. Let's be clear what the words were used. I've been having this debate with you guys for 2 months about rate hikes versus financial stability. Yep. And I'm just saying that, I'm aging myself. I was here in the 80s.
Again, also want to remind everybody, give us a like, give us a subscribe. We like to do these live streams as often as we can, specifically on big data announcements like today. We always like to bring some kind of educational piece to them. So again, like I said, we're going to have our head developer Ruslan on to talk about some periphery tools on the strategy tester that can help you with, refining your strategies. Give us a like, give us a subscribe. It'll prove to us that you guys like these and you want us to keep on doing them. We got Powell here
It feels like
any
a
minute
longer
now.
tail to me.
Yeah,
So when you
I
say
would
that,
agree
when
with that. I think even if there is a mild slowdown, but there's not, contagion in the banking system, I still think that they will hold rates where they are as long as inflation is above their target. That's where I stand.
And as soon as this comes on,
I'll read out here.
gonna
The
tune out
CNBC bond yields
of
turned
this
lower
Twitter
and
space.
stocks inched higher as traders weighed the latest post-meeting statement from the Fed. This time, the central bank seemed to soften its stance on future rate hikes, dropping a line about, quote, additional policy firming from its statement. And I've got another one here. I'll read it out. We've got like a minute before the conference starts. So we've got another one here. This is a strong signal from the Fed that the funds rate has hit its cycle ceiling. Powell won't close the door to incremental hikes completely, but removing that line is the FOMC's way of telling markets they're putting rate hikes back in the toolkit. And if we saw Wall Street,
All right,
by the
here
way,
we go.
interrupt me name when it starts,
We
but
are
we
live.
did see a comment by the Wall Street Journal comparing
get
this
outta
to
here.
2006.
And do let me know if you guys have any trouble hearing this. I try not to give opinions whenever I'm live. I try not to give opinions. Definitely do look at a lot of charts and happy to utilize any of the tools on TrendSpider to kind of gain or glean some sort of insights, but I try to leave my opinions at the door. Bradley. 2 years of using TrendSpider every day, man. Big props to you. That's awesome. It's the big show. Let's see what he says.
Good afternoon.
Again, let me know if
Before
it's too
discussing
quiet.
today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the
I've got this
FOMC
thing turned
raised its
up as
policy
loud as
interest
it can
rate
go.
by a quarter percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Oh, gosh, guys, I'm sorry.
We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses.
Awesome, Sean.
In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change, that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Chairman, oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria. Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
Is an interesting question.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that you know, interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, you know, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and you know, we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's, you know, we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and you know, make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time, and that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're gonna need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%,
seems interesting,
going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal. And right now, we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So to get, I think as goods pipelines have gotten, back to normal so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee
doesn't want to answer this.
Have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing, we don't think now. It hasn't actually been growing. It moved down and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory, the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way.
He's getting phased.
There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved.
What's up, James?
And all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system and we'll factor that assessment into our decisions in an important way going forward.
Greg?
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly. And I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Well, what do we think, y'all? That's that. Seemed like it kind of went off the rails a little bit. Market seems not to have liked it. Let me throw back some music real quick. Real quick, y'all. I got a message from Russ during Powell's speech here, and Russ is the father to a small child, and it seems maybe that there was some sort of emergency that he had to tend to. So unfortunately, our lesson that he prepared is going to have to be foregone until next week. We've got CPI data coming out next week that I'm going to be live for. We're going to bring Russ back in for that. And I really apologize. I know some of y'all were sticking around for it. I was really excited for it. Never a bad time to brush up on skills. So I was really looking forward to get to talk with Russ and ask him questions and have you guys learn some cool stuff from him. But unfortunately, he cannot make it any longer today. So bummer. Yeah, thank you, Robert. I will send that along. Real quick, before I get up out of here, let me do a couple of things. First of all, let me pose a question to you guys. Does anybody have any questions about the TrendSpider platform? Anything that I can answer while you've got me live? I want to be as helpful as I can. So if you have anything you're curious about, do ask those questions here in chat now. While you're doing that, I'm going to grab a couple of links that I want to share with you guys. First of all, let me give you this. This is for the space today. This is at 6 p.m. Eastern Time. If you're interested in joining us in the spaces today, we're going to have a good conversation with some smart folks. So please join us. Yeah, Eco, I would if I were going to stick around, but I'm going to get up out of here. Added Bybit to Signal Stack. Bless up. Yeah, man. So you need Kraken? Is that what you're saying? Bless up to big homies, TrendSpider, for making that happen. But May 8th, Bybit won't let Americans use the VPNs. Interesting. Good to know. I did not know that. Any other questions? If you have not already, please like and subscribe to TrendSpider's channel here on YouTube. The more likes and subscribes we get, the more we can do these. So if you guys are tuning in and enjoying it, hook us up. Let us know that you are enjoying it by giving us a little like and subscribe. That helps us out a ton. And yeah, I will be live tomorrow morning for pre-market starting at 9 a.m. Eastern time. I'll be here for an hour. This is just my normal Tuesday, Thursday pre-market show where I just hang out and talk shop and answer any TrendSpider related questions that you guys might have. So if you want to join me for that, you're more than welcome to do so. Again, if you are not yet a TrendSpider user and you're interested in becoming one, let me get you guys a discount code here. This is for 35% off the plan of your choice. We do have 7-day free trials. You're welcome to help yourself to this code and a free trial. If you have any questions, you are more than welcome to hit me up anytime. Let me show you guys this. Where is it? This. Yeah, there we go. That's my name. That's my Twitter handle at Krutzky Trades. Please give me a follow. My DMs stay open. If you have any questions about TrendSpider, you are always welcome to DM me or ask me on Twitter. I'm an open book. I'm happy to help however I can. And yeah, you guys, that's it for me. I really do appreciate y'all hanging out. And I'm so sorry about Russ. We were really excited. We planned this whole thing. We've been working on it. So this is a bummer that he has had to cancel on us last minute here. But I promise you, he was very excited about doing this too. So whatever's going on his end, this is not, he's bummed about it as well. So yeah, thank you guys all so much for being here. If you're around 6 p.m. Eastern time, please do pop into our Twitter space. We'd love to have you. If you have any questions for any of our guests during the space, feel free to ask those in the chat on the space. You're welcome to ask. I keep my eyes on that chat. Any questions that come in, I try and get to them at some point. So again, thank you all so much for tuning in. It's been a pleasure hanging out with you guys. I see a bunch of names that I recognize, a bunch of regulars here, 88 and Robert and Eco and James. And yeah, it's awesome to see you guys here continuously supporting the channel. And we do really appreciate it so much. So with that, I'm going to sign off. It has been a pleasure. If you're going to be trading any more today, be safe out there. It looks like the markets are trying to rally a little bit now that Powell is done talking. They're trying to bounce this thing. We'll see where things go into the end of the week. I hope you guys have a great rest of your day. Holler if you need me. I am always around. And I'll see you again maybe tomorrow morning, maybe next week. But yeah, all right. Take care, guys. Have a good one.